Clear. And the last one, the passage of time. As the year goes by, the value of the asset would come down. That is depreciation. Clear. Is it clear, please? Good. So go down. Reason for charging depreciation. Are you there? The charging of depreciation for each accounting period that benefits from the use of non-current assets is an example of application of accrual concept. I told you already that we charge depreciation because of the accrual matching concept, which means we have to classify expenses at that time we purchase it. No. Okay. So reason for charging depreciation, I said the first one, it is part of the accrual principle, which is accrual matching concept. You charge depreciation based on the value, the year or the time you purchase it. So the part of the cost of a non-current asset is matched to the revenue generated from the use of that asset. So this is a laptop or this is an equipment. So you continue to use that equipment. The value of depreciation should be charged based on what you are using it for. Do you get it? This asset is being used. You are using that asset. The cost of it must be charged, must go in line with the amount of money it's generating. You are using it to make money. So that means you have to charge depreciation based on the money you make from it. Do you get it or not? The part of the cost of a non-current asset is matched to the revenue generated from that asset. You have purchased an equipment. The equipment is used to generate revenue, yes or no? So the cost charged on depreciation should be part of the revenue generated.
But it has nothing to do with the revenue you're making.
The revenue you make is through what? Through the machinery.
What if I'm using a laptop?
Yeah, you make money from the laptop.
Yeah.
When you are charging depreciation, it has to go with the value, the amount of money generated from that laptop.
So if I make a ledger, I will add the depreciation with the revenue made.
If you are making a ledger, as soon as there's depreciation, we have the cost account and the depreciation account. In your cost account, you debit the historic cost.
The historic cost.
Yes. And in your depreciation provision for depreciation account, you credit the value of depreciation. So you are making, the cost is 10,000. Then it is expected to depreciate by 5%. So 5% of 10,000 goes to your depreciation account. Where do you get the 10,000 from? From the value of the assets. So that's what I meant by the part of the cost of a non-current asset is matched to the revenue generated. Clear? Therefore, depreciation is a non-cash transaction. So you won't have the figure of depreciation. You don't have the amount in hand, but it has to be deducted. So there's no cash transaction between the business and any other person. There's no transaction. But what we only know is that we are making a provision for depreciation based on the fact that there is an asset that has been purchased. So the transaction goes with the asset that is purchased. So you're just taking that big figure away from that asset. Is it clear? Is it clear, please? Okay, we'll go to methods of depreciation. So we have straight line method, we have reducing balance method, and revaluation. For straight line method, we're going to find the cost and the residual value with the economic life. The economic life is the same as the useful life. Are you with me? So for depreciation per year, it is cost minus residual value divided by the economic life. So if the asset is expected to be used for 5 years, that means the economic life is 5 years. The residual value is the amount you're going to sell the asset after the economic life.
So how much you bought it for and how much you're selling it for?
The amount that is expected to sell it. You're expected to sell it is your residual value.
So you, like if I buy property now, so I will say how much I will sell it for, like in 5 years.
After depreciation, you get a value. So the value you're selling it minus the amount you bought it, based on the years it has spent, gives you the depreciation.
Oh, okay, yeah.
Is it clear? So residual value is the amount of the asset, the amount the asset will be sold after its economic life.
And
then accumulated depreciation, what?
And depreciation per year cost myself. Yeah, this 2 times depreciation rate.
Yeah.
So you have to do this equation first to get the second equation.
Yeah, but mostly if you're not given the depreciation value, you could still get